Good morning, everybody. I'm Vali Nasr, the Dean of Johns Hopkins University School of Advanced International Studies, and I'm very pleased to welcome you all to this event. And I'm particularly honored to welcome Dr. Frederic Neumann to Johns Hopkins SAIS for a conversation on Asia's economic challenges. This is obviously a very important and interesting topic these days that given the new administration's focus on trade and relations with Asia, particularly in the economic sphere, this would be a very timely conversation. This conversation is part of the school's Evolution or Revolution speaker series. Dr. Neumann is Managing Director and Co-Head of Asian Economic Research at HSBC Bank, based in Hong Kong. It's a global financial institution that many of you who are looking to careers in finance are aware of. Prior to joining HSBC, Dr. Neumann was an adjunct professor at several universities, teaching courses on Asian sovereign risk analysis, international financial markets, international monetary policy, and Southeast Asian political culture. He has served as a consultant on Asian economic and political affairs to the World Bank and various governments, and is a former research associate of the Institute for International Economics in Washington, D.C. He's a former Fulbright scholar, and I'm very pleased to say that he received his PhD in International Affairs from Johns Hopkins SAIS, so he's part of the family. Today's session will be moderated by Dr. John Lipsky, who is a Peter G. Peterson Distinguished Scholar at our Henry A. Kissinger Center for Global Affairs, and also has been a scholar at our Foreign Policy Institute as well, and who has been moderating these Evolution and Revolution series at this school. We are truly fortunate to have two economic policy heavyweight with us today who have served on the front lines in assessing and shaping Asia's economic trajectory, and whose opinions and experiences, particularly at this juncture in time, are very relevant and very much sought after. So I look forward to their insightful discussion of the challenges facing the Asia region today, and also their views on the prospects for the future. Without further ado, please join me in welcoming Dr. Frederic Neumann to the podium.
Thank you, Dean Nasr and John Lipsky, for the kind invitation. Thank you for joining us here this morning. I kind of feel like I've just been in the audience. I graduated about 10 years ago, but it feels very odd to stand up here. When I graduated around mid-2000s, 2003 in fact, we just started the hostilities in Iraq. And I remember Ted Kennedy standing at this very podium here and giving a speech, and it was absolutely packed. And that was his key speech, railing against the invasion of the Iraq War. And I cannot tell you how much of an impressive and passionate speaker Ted Kennedy was. It's almost like if you saw the Saturday Night Skid with Michelle McCarthy when she sort of carries the podium, when she he was about the same, carrying this podium around and sort of knocking on the podium. It was really very impressive. So I'm very honored to be up here. What I propose to do is basically give you a flavor of the message that we carry to clients. It's perhaps a bit more short-term than you're used to. I imagine here at SAIS, we still talk about sort of 5- and 10-year cycles, not necessarily 2 or 3 years. But in financial markets, our views tend to be much more short-term. As an economist, we think in 1 or 2 year cycles. I meet clients who think in hourly cycles. Hedge funds will trade currencies, with a view of 2 or 3 hours or half a day cycles. I want to take sort of 1 or 2 year view. And I'm just going to show you a few slides to put things in perspective. And the bottom line here is that emerging Asia is at a very critical juncture. Since the global financial crisis, we've seen impressive growth across the region. That was largely fueled by debt. As exports to the Western world collapsed, the region had to look inward. We had to leverage up our balance sheets, and growth was really driven by an expansion of investment, all debt finance. And the problem with that growth strategy is that it's running out of runway. We have already very stretched balance sheets. We've already invested quite a bit. Households have leveraged up. And so the domestic engine is starting to sputter. And ideally, at this point, you would want to switch back to export-led growth, going back to have exports be the main driver to allow you to consolidate your domestic debt levels, give you a bit of space to apply structural reforms. And the problem is that rebalancing towards exports is not working because in the Western world, we still have fairly lackluster growth, but more importantly, because we now have the rise of protectionism. And that could potentially throw sand in the wheels of the export sector and thereby slow down economic growth. So on both the domestic side and the external side, we're facing a bit of headwinds. And that makes it even more important that we press ahead with structural reforms to raise productivity. And that requires very tough choices domestically by politicians, above all Xi Jinping in China, who needs to finally push ahead with state-owned enterprise reform and all the laundry list of reforms that we've been talking about for many years. That's sort of the main message. I want to show you a few slides to put things in perspective. What you see here is just a snapshot of where we stand in the world. It shows you the level of industrial production in different regions. Since going back to 2000, if you just look at the red line, this is the output level in the United States. And if you sort of trace out the red line, you can see that over the course of the 2000s, we had a strong expansion of economic growth here. In September of 2008, everything started to collapse because of the collapse of Lehman Brothers. The U.S. financial system froze up, and that pushed the U.S. economy into deep recession. In fact, we haven't seen such a deep recession probably since the 1930s. At the lowest point here, we lost about 13 years of output gains. That is, sort of within 6 months, the U.S. economy lost 13 years of output gains. Subsequently, you see that the U.S. economy recovered very gradually, steadily, despite massive quantitative easing. The recovery path was actually very shallow. And the point here of this chart is really to say that even today, on this particular measure, we're still about 1.3% below the peak in 2008. Now, this is industrial production. You can look at other measures. On other measures, we're slightly above it. But I think it's a reminder that in the industrial sector in particular, we've not really made up all the lost ground. And I think that goes a long way to also maybe explain some of the political surprises that we've seen here in the last few months, because it does signify ongoing job weakness, particularly in the middle of the country, which has been particularly disrupted by the manufacturing recession. If you look at the euro area, what's surprising is that before the global financial crisis, Europe actually had stronger growth than the United States. It peaked out here, but was brought down by the collapse of Lehman Brothers as well. Similarly, it just collapsed in output. And at the time, most observers were surprised that Europe was dragged down into such a deep recession because, after all, it was a US housing crisis and not a European housing crisis. And the answer to that puzzle is that Americans were smart enough to sell their mortgage-backed securities to European banks. And nobody at the time actually saw that coming. But when American households defaulted on these mortgage-backed securities, it froze up the European financial system and plunged Europe into this deep recession. But what you see here also is that Europe recovered just as quickly as the US did, but something went wrong in the summer of 2011. We had the Eurozone crisis. It was a second-round crisis in Europe, and that pushed the region back into recession, and it's barely recovered since then. And today, output across the Eurozone is still about 9% below the absolute peak before the global financial crisis. Again, on other measures, we've probably recovered more ground, but the bottom line here is, at least according to this measure, we barely made up all the ground we lost previously. Now, if you look at the blue line, it's a story of tremendous success. That's emerging Asia. You see output increasing. You see, first of all, the global financial crisis barely registers as a blip here. And today, output is 77% or so above the peak in 2008. That is an astonishing gain in economic output, particularly considering that the Western world was not buying the products that we were producing in Asia and that really lay behind the decades of growth previously. So we were able to sustain growth despite absence of Western demand. The question is, why was Asia so resilient? And the answer lies in this chart, and that's probably the most important I can show you in the entire presentation. It shows the bank credit to GDP ratio for emerging Asia, how much bank lending there is as a share of GDP. And it actually goes back to 1991. It's worth to spend just a few minutes on this, because in 1991, Asia had a bank debt to GDP ratio at 80%, fairly low leverage. And at the time, the US economy actually went to recession. The Federal Reserve cut interest rates. At the time, the Japanese real estate bubble burst, and the Bank of Japan also cut interest rates. And as a result of low interest rates in Japan and the US, money flowed into emerging markets. Funding was very cheap, and that encouraged a leveraging up process in subsequent years. And you can see the debt to GDP ratio climb very gradually over the years in emerging Asia. And this is sort of the time when you see golf courses being built in Jakarta and skyscrapers in Bangkok, and money was just extraordinarily cheap. The problem was that by the mid-1990s, the Federal Reserve starts to raise interest rates because inflation is coming back, and Japanese banks realized that they had overextended themselves in the region and started to pull back loans as well. And that's what triggered the Asian financial crisis in 1997. All the money that rushed in and financed the investment now began to rush out again. And the impact on the region is clearly visible here in this chart when you see the sharp decline in leverage ratios for the subsequent 4 years. Leverage just collapses. Investment grinds to a halt. Balance sheets need to be shrunk. Companies need to be closed. People are laid off. And the only thing that really sustains growth at the time is, again, exports to the Western world. And even in 2001, when sort of the decline comes to a halt, the repair process is not over. It lasts for another 5 or 6 years. In fact, I remember traveling in Thailand as late as 2006, 2007. You still saw these remnants from the 1990s boom, these skyscrapers half finished. They were just standing there. That was as late as 2006 and 2007. Now, when the global financial crisis hit, one big advantage for Asia was that we had spent the last 10 years cleaning up our balance sheets, shrinking our debt levels. So we entered the global financial crisis with extremely low debt levels. And once again, the Federal Reserve cuts interest rates. The Bank of Japan pumps money into the financial system. Local central banks in Asia cut interest rates as well. Now the ECB also has its foot on the gas, and that leads, again, capital rushing into emerging Asia. We start to lever up and lever up and lever up. And this process is really what continued over the last 6 or 7 years. And if you wonder why output is now about 70, 80% above the peak in 2008, this is the answer: the ability to leverage up. But there's also a problem with this, and you can see that at the very end here. You see this wiggle where it started to slow down. So in the last few quarters, we see actually a deceleration in credit growth. And there are 2 reasons for this. One is that interest rates in the West are starting to rise again, sucking capital out of emerging Asia. In fact, in the 4th quarter of last year, after Trump won the elections and US interest rates started to spike, suddenly you get record capital outflows out of emerging Asia. That reduces funding available for investment, and raises funding costs, and thereby slows down the increase in leverage and also economic growth. And the other issue is that local balance sheets are already very stretched. If you look at households in Asia, in places like Malaysia and Korea and Taiwan, household leverage is essentially maxed out. In Malaysia, we're approaching household indebtedness levels that are similar to what the US had at the peak before the global financial crisis. If you look at state-owned enterprises in China, their leverage ratios are some of the highest in the world, measured by debt equity ratios, for example. So that increase in leverage is also providing sort of a level of debt saturation, which makes it harder to leverage up further, and that is a critical restraint on economic growth. Now, in this environment, you ideally want to see exports gradually improve to buy you some time to apply domestic reforms and get away from this debt dependence. Nobody expects surging exports anymore, but at least some improvement to restore sort of the vibrancy to the external sector. The problem is that we're facing a structural slowdown in emerging Asian exports. What you see here is export volumes out of emerging Asia going back to 2001. And just to bring home the point about the structural deterioration in export performance in Asia, before the global financial crisis, on average, Asian export growth in volume terms was nearly 15% every single year. That's an enormous increase in exports every single year. After the global financial crisis, that went down to about 4.5% on average. But in the last 2 years, we virtually saw, if you just look over a 2-year horizon, virtually no growth across Asia. So there has been a further deterioration in export performance in Asia, even before we apply any of these protectionist restrictions in the Western world. So Asia has a structural export problem, and we're often asked, where does this come from? Why does Asia suddenly see the slowdown in exports? And these are structural factors that are not going to go away anytime soon. If you think about, for example, US consumer spending, what is sort of one of the sectors that are doing very well of late? Well, one of the sectors is healthcare. Why? Because Americans are aging, healthcare expenditure are rising, but healthcare is not something where Asian economies are very much exposed to. Asian economies revolve around consumer electronics. But guess what? That sector isn't growing anymore. Everybody has a smartphone now. We're no longer seeing volume growth of 20, 30% coming through. If you think about PCs and laptops, for the last 6 years, the market has actually shrunk across the world because we're no longer buying as many electronics as we did before. So the change in consumption pattern has something to do with the structural decline in exports, as have issues like rising labor costs in Asia, which makes it at the margin more attractive to bring some production back into the Western world. We also have had a lack of trade liberalization agreements over the last 10, 15 years. Since really China joined the WTO, there's not been a major global trade liberalization agreement that would serve to keep expanding global trade and therefore act as a spur to Asian growth. Incidentally, the TPP was held up as one of these new big arrangements that would at least help part of the Asian economies to revive their export growth, but that's now out. And therefore, we're facing not just a structural deterioration in Asia's growth performance, but it's also very unlikely that that will bounce back anytime soon, and hence putting even greater pressure on Asian growth rates because the domestic side already is struggling. I want to show you a few other charts to put things in perspective. We can talk more during Q&A about exports and different aspects in Asia, but I wanted to delve a bit deeper into debt levels in Asia because that's what makes the headlines. That's something that you certainly see discussed in the Wall Street Journal, and investors always ask us about. And what you see here is the total debt levels in individual Asian economies. And the second chart I showed you, so the average for Asia, and you see it going up in the last few years. This is just a snapshot of the current debt levels in individual Asian economies. And what's interesting is that the debt levels vary enormously across the region. So it's not as if every economy has massively leveraged up. In fact, we have a number of economies in Asia that have very low debt levels. In fact, Indonesia, on the right-hand side here, has one of the lowest debt ratios of any economy in the world, having virtually no private sector debt and very limited government debt. Also, the Philippines and Sri Lanka and even India have actually extremely low debt levels. And so when I talk to an equity investor who tend to invest over 2 to 3 year horizons, and they ask me, where can you get most of your growth in Asia? I want to invest in a market that has a potential to accelerate economic growth over the next few years. Where would I put my money? And one of the ways we answer this is to say, well, you want to stick to these economies where there's very low debt levels, because only there can you get a positive credit cycle, and that's these economies here on the right. On the left-hand side, you see highly indebted economies, Singapore, Japan, and Hong Kong. Now, it's a bit unfair to lump in Singapore and Hong Kong because those are financial centers, and that's like showing you the debt-to-GDP ratio of the City of London in many ways. But nevertheless, debt is very high among households, for example, locally. And here, probably rising interest rates will have a massively decelerating impact on local demand. And Japan stands out because it has very high debt, but you can see that virtually all of this debt is this gray part here, which is government debt. The private sector has very low debt levels in Japan. In fact, corporations in Japan have enormous cash reserves. They're sitting on retained profits and cash reserves equivalent of 60% of GDP, which is unheard of. I think even the US doesn't come close to that. Now, what about China, the one that everybody is always worried about in terms of debt levels? Well, the first thing to notice is that China is actually in the middle of the pack. It's not even an outlier. So if you're worried about Chinese debt levels, you certainly should be worried about debt levels in Malaysia, in Korea, in Australia, because here debt levels are much higher, and these economies don't even grow that fast. So that should make you even more worried about the total debt levels. The other thing to note about China is that government debt is a substantial part, but the biggest part is bank lending to corporates, the dark gray part of the bar. But bank lending to corporates in China means essentially bank lending to state-owned corporates. So that if you take 75% of bank lending to state-owned corporates, and you take government debt in China, the vast majority of debt in China is in the public sector, not in the private sector. And that makes a huge difference in terms of the sustainability. It reduces the risk of an imminent financial crisis if most of your debt is somehow in the public sector. I'm not arguing that this is a sustainable growth recipe, but it does reduce your risk that a sudden defaults or spreads like wildfire and cripples the financial system. In fact, China has certain advantages. It has excess savings. It has a current account surplus. It has capital controls that trap most of these savings in the country that can't get out. And the government owns the big banks that allocate these savings to other public sector entities. And that makes a financial crisis far less likely than, say, in the US, where most of the debt was taken out by private homeowners, and most of the debt set in the private sector, and the US had to borrow savings from overseas to fund the expansion of credit. Now, none of this says that China is sustainable on this current buildup in debt, but we don't see necessarily that becoming an issue in the very near term. In fact, if you wonder how far you can push up public debt to GDP ratios, which essentially in China I argued that debt is a public sector issue, just look at Japan. You can push up public debt to GDP ratios for a long, long time before it actually becomes a macroeconomic problem. So this is an overview of the debt levels in China. Just in the interest of time, one other word perhaps about the issue of infrastructure in China. Where does all this debt go? Well, part of it is housing in China. Part of it is infrastructure. And then one question we often get from investors is, well, China's building all that infrastructure. At what point do you run out of infrastructure to build? At what point does it become sort of detrimental to add yet another rail line, another subway, et cetera? And our message remains that China has still vast scope to increase its infrastructure stock. In terms of, for example, when you look at the amount of infrastructure per capita in China, we're roughly at 20%, the US level right now. So that suggests there's a long way to go. I know that the numbers are, in terms of China's construction sector, are incredible. Last year, China imported 32 tons of iron ore every second to fuel its steel production. Between 2010 and 2012, China used as much cement as the United States did in the entire 20th century. So it is an enormous construction bubble. But it is also a vast, vast country. Beijing has the same number of residents as all of Australia, and Beijing is just one of probably 150 cities in China that have more than 1 million inhabitants. But we tend to show this particular chart to clients, which they really like, particularly the bullish ones that work in equities. And so if you have the upper left side, you have the Tokyo subway map that shows you a very intricate network. Then you have Beijing's subway map, then Chengdu, and then Dongguan, where apparently, as of today, there's not a single line in operation. I have to be a bit careful here because we need to update this chart every 3 months because there's so many subway lines are being rolled out. But you get the broad picture. There's still a lot that can be done. Incidentally, for me, one of the interesting things about this chart is that you may have noticed that global banks have sort of, invested a lot in compliance and regulatory frameworks in recent years. And even my line of business in research, I started off with 1 compliance person for our research operations. Now we have 4 compliance officers, making sure that all our research is up to par. And so when we hired the 2nd or 3rd compliance person a few years ago, they looked at my presentation and they looked at this slide. And I used to have a picture, a photograph of the Tokyo subway map on the upper left corner. And so they called me and said, we looked at your presentation, it's all very nice, but do you have a copyright to the actual picture of the Tokyo subway map? And I was like, no, I don't. I just got it off the internet. They're like, well, you need to have copyright. And so I called the Tokyo subway map copyright office to ask for approval, and they had no idea what I was talking about, so they said no. But I still like the map. And so what you see here is a hand-drawn rendition from one of my economists in Bangalore who sat there for a day and copied the map by hand. And I think he did a pretty good job. Thank you for your attention. And I think we're now just going to have a bit of a conversation. Exactly. Thank you.
That was instructive and good fun besides. Now what we're going to do here is Fred and I are going to have a conversation for a little while. I'm going to pursue a few of the themes that I think will be of interest, and then we will turn it over to the audience for Q&A. So, anyway, thanks very much for that. For that, I can't resist. For this last infrastructure slide, of course, you have to think about different income levels, too. And so when you say that the infrastructure per capita is X percent, also per capita income is X percent. So I think that will, over time, govern the speed at which it makes sense to increase infrastructure. In other words, lest you think in just a few years, Chengdu should look like Tokyo. It probably, even if it were technically possible, probably wouldn't make economic sense. So let's go continue with China, because I suspect that's an economy that's going to have critical importance for Asia as well as for the rest of the world. When President Xi Jinping came to the United States 2 years ago and spoke in Seattle, basically his message was, my primary task is economic development in China, to eliminate poverty, to ultimately bring China to become a middle-income country and eventually a developed country. And he said then, in essence, I've concluded, and the experts have told me the only way I can get this done is through pursuing the thoroughgoing economic reforms that were encapsulated in the 13th five-year plan. How is that going? Because that's, that involves some pretty profound changes in how in the structure of the economy, how the incentives are structured. Is that, I think there is some question about the speed and the conviction with which the government is pursuing these shift towards a more market-driven, more consumer and services-driven economy, away from construction, away from export-driven growth.
Yeah. Absolutely is a disappointing, the reform process has been very disappointing in China. In fact, you could make the argument that China has in the last couple of years gone backwards. If you just measure the share of the state in GDP, it's actually increased rather than declined because of the emphasis on infrastructure. So in some ways, China has gone backwards. There are two explanations why Xi Jinping has acted more slowly in terms of when it comes to the reform process. One is that one school of thought is that he faced a lot of resistance from vested interests, and that he needs to centralize power, concentrate power in his own hands. That's why he's using the anti-corruption crackdown. And by this school of thought, once you consolidate the leadership this year, then you can expect next year this whole blossoming of reforms and acceleration of sort of tackling state-owned enterprises and going against some of these vested interests. The second school of thought says, well, he's already consolidated his power to a substantial degree, and what's holding him back is more an ideological problem, and that is that he may not necessarily endorse some of these recommendations that have been made, particularly by the Premier, Li Keqiang, and others, and that he's more about strengthening the state and the CCP's control over the economy, and that he sees that as sort of, creating publicly owned national champions as the way to future prosperity. So it's an ideological sort of resistance rather than necessarily power politics. And my suspicion is that the latter explanation seems to have gained more credence in recent years, because in my view, Xi Jinping has already amassed so much power that by now he surely would have pressed ahead with some of these reforms if that's really what he's after.
Then let's come back to the original point. Is strong growth sustainable in China without thoroughgoing reforms?
No, not indefinitely. One way sort of to make projections about China is to say that China is not sustainable in the current trajectory. So the increase in the debt to GDP ratio is not sustainable. The capital outflows are not sustainable. We have capital outflows of several $100 billion every month. That can't go on forever. Environmental terms is probably not sustainable unless you do something politically, perhaps. The question is this going to be binding in the near term? And the issue is, no, it's not going to be binding by the third quarter this year. It may not even be binding in 2 years. Maybe in a 3 to 5 year horizon, these constraints will become binding. So it's not as imminent as some of the headlines suggest in newspapers. But I suspect that unless we see a real stab at structural reforms, these constraints in 3 to 5 years will become binding, and you'll see a sharp deceleration in economic growth. This need not entail a US-style recession with minus 5% growth. It may just mean that China's GDP growth goes to 1%, 2%, and lingers there for many years to come, and we have a middle income trap kind of situation. But unless something is done, at the very least, we would think that economic growth slows down to 1 or 2%.
Mm-hmm. So this story isn't over, but it's not going to get determined quickly. But something has got to give one way or another, either the growth rate or the reform program in the next 3 to 5 years. Is that
Yes, that's
fair enough?
right. Although, I'll be frank with you, a lot of the investors that I speak with, as you well know, having talked to investors for a large part of your career as well, is that they tend to put the timing on a much closer horizon. And one big debate in financial markets right now is the degree of FX reserve losses. So China still has 3 trillion, or just under 3 trillion reserves, but if you keep losing $50, $100 billion a month, you can quickly calculate at what point reserves go down to a level where something more drastic needs to happen. And this could be 12 months, 15 months, but people who look at FX reserves drawdown certainly think it's a much more imminent problem.
Mm-hmm. So let me follow on that, and I want to come back to the financial sector in a little more detail. But let's just look at the reserve loss. So the country as a whole still has a current surplus. So net capital is arriving from abroad. Yet, with this huge loss of reserves, really $1 trillion in a relatively short span of time, means that some Chinese are getting their money out one way or another. Is it a combination of, on the one hand, perhaps disappointment in the reform process, secondly, a sense that with rapid credit growth, the outlook for the RMB is continued depreciation, not appreciation, and therefore Chinese investors and companies want to get out of RMB? Is that and that has led, naturally, since the government doesn't want to slow down credit growth as a policy, has instead resorted to beginning of capital controls, or at least measures that would inhibit the ability of corporations and individuals to take money out of the country. Is that a fair description of what's going on? Is it a little too dire? And but you suggested if this continues, it can't go on. How will it stop?
In terms of the motivation for capital outflows, it is private capital that is going out, and the motivations are all of the above. So there's short-term speculation on currencies. If the dollar appreciates, you want to buy dollars and get out of the currency. That's short-term speculation. Then there's money that is more long-term that leaves because people were unhappy living in China, maybe want to move to the West Coast. You also have the issue, because China had for many years maintained fairly stringent capital controls, that people in China want to diversify their assets. So this is portfolio diversification theory. So you say, I have 100% in my renminbi account now. I'd like to get 20% into US dollars just to diversify risk. And so that means there's a lot of pent-up demand for US dollars. That means there is a structural outflow that's not going to disappear anytime soon, even if the Chinese were to raise interest rates or the dollar appreciation were to slow. That will not eliminate entirely capital outflows because of some of these more structural drivers behind this. Is then the conclusion that China's exchange rate regime is doomed? I wouldn't go as far as that. There is, for example, what they've done in the near term is to plug the loopholes in terms of capital outflows. They've made it much harder, at least temporarily, for ordinary citizens to take their money out. And I stress temporarily because the broad policy goal still remains to internationalize the currency, but at least for the time being, it's a very pragmatic response. And so the hope is that once you reestablish the confidence in the Chinese currency, you can then relax capital outflows. Some people take their money out, but they also bring foreign money in, and so the two equilibrate, and therefore you've established balance in the balance of payments. but you need to do the reforms first, establish confidence among foreign investors in your country to offset the outflows that are still structural.
Yeah. And of course, there's a tendency still in markets to look at the RMB against the dollar as the benchmark. Even though the dollar has been going up, and the Chinese authorities have said their benchmark is a real effective exchange rate. So in essence, their policy would imply, as long as the dollar is strengthening virtually against all other currencies, that their policy would be to allow the RMB to weaken against the dollar.
That's right. The Chinese have actually run a very stable currency against a basket of currencies. The problem is that the average person in China really looks at the US dollar, and it's almost you have to convince the population to look at a basket rather than the US dollar. And how do you do that? That's very tricky.
Dare I say it, I think there are a lot of people in this town, perhaps that end of town, who tend to look at the RMB against the dollar, forgetting the broader situation.
And there are more people in that part of town.
At any rate, well, we could go on this topic. I can't resist one quick further question, then I'll move on to other places than China. Very striking, the level of growth of credit in China. The overall level is not so striking, but what you pointed out, strong growth in bank credit to state-owned enterprises.
Yeah.
A lot of that credit growth had come not through the conventional banking system, but through the, we'll call it the non-bank, around here they like to use the word shadow banking system. Is that creating problems for control? Is that going to continue where there's strong growth in the non-bank financial sector and less in the conventional banking sector? Or are authorities taking efforts to rein in that let's call it innovation?
So I think the shadow banking issue is sometimes a little bit overplayed. Mm-hmm. I'm not quite as worried about it. One thing to say is that in total asset size, if you look at total debt in China, shadow bank assets are still really a small part. It's growing fast, but the overwhelming amount of credit in China is really extended by banks. So it's more vanilla loans. The second thing is the definition of the shadow banking system, which in China includes the bond market, and we wouldn't really call that,
right.
It's not really shadow in that sense. So if you take that out, it's not quite as bad. The third thing is that the Chinese authorities are actually quite attuned to that risk. Now, it's a risk that keeps coming up, but it's not as if they don't understand those risks. And we had for those who follow China a bit more closely, you will have noticed that interest rates were rising quite sharply towards the end of last year. And that was actually a deliberate attempt by the Chinese to squeeze out an emerging bubble in the shadow banking market. What happened was that individuals or institutions were buying so-called structured products, which are products where you borrow money in the interbank market, you leverage up and you buy bonds. And this is a speculative product. So essentially you create artificial bond demand by creating a product that leverages up enormously. And you can see how risky that is, because when leverage dries up, demand for bonds declines and the bond market collapses. And so what the Chinese were doing is they were squeezing the interbank market to get rid of these structured products that were speculative positions in the bond market. So at least there's some understanding that you need to curtail these risks. But, of course, it's always running behind kind of the emerging risks, because you plug one hole, another one emerges. So you need to be quick on your toes.
Great, thanks. Well, I could continue in depth with Fred, but let me move on beyond China. A few questions before we turn to all of you. Japan, still one of, I guess, conventionally now viewed as the third largest economy in the world, no longer the second largest, although you could discuss that, but growing relatively slowly, as in very slowly, partly reflecting demographics, partly reflecting their economic structure. Even a slower growing China is growing much faster than Japan. What would you see? What is the outlook for the Japanese economy? Still very large. What is its role going to be in a developing Asia in the future?
So despite the fact that Japan's economy isn't growing very fast, although this year it's growing above 1%,
Yeah.
which by Japanese standards is like 10% for China. So they're feeling very good about themselves at the moment. Despite the fact that it's not growing very fast, Japan is still a massive technological leader in the region, has a lot of know-how, and has, a wealth that is unparalleled in the region, and so has deeper resources, even though it's not growing as fast, but has very deep resources. And the Japanese, therefore, in terms of the economic role, is that they're still, in many ways, leaders, economic leaders. They're very big providers of foreign direct investment, particularly in Southeast Asia, into Vietnam, into Thailand, increasingly into India. There's an interesting, increasing, I would say, rivalry perhaps going on between China and Japan. So it was very well reported is that the Chinese, through the Road and Belt Initiative, the AIIB, are investing enormous resources in Southeast Asia and South Asia. But what's less reported often is that the Japanese also are doing, committing very substantial funds. And so I think even though it's not growing as fast, it still has deep enough pockets to play that very vital economic leadership role in the region, and it will probably take several years before China really displaces the economic heft that Japan has.
In that case, is it reasonable to say, okay, Japan has unique demographics among the industrial economies, extremely slow growth, well, actually shrinking population, and an aging population. As I said, in a few years, Japan is going to look like Florida if they don't end up with a lot of immigration.
Actually, sorry to interrupt you, it's more going to look like North Dakota at some point, because demographics, if you project out the current birth rates, you'll find that by the year 2300, there are 14 Japanese left. And they're going to sit overlooking Tokyo Harbor and, I guess, turn off the lights. But that's how bad it is. 1% per year population shrinkage. 1% per year.
So is it reasonable to say what they've done, instead of allowing immigration, they've moved their capital to where the workforce is in Asia?
Yeah.
So in essence, you can say the Japanese economy, the Japanese-owned economy has expanded. A lot of it has not been in Japan.
Yeah, that's right. You very clearly see that. The stock of foreign assets by the Japanese is increasing. They're exporting capital rather than importing people. And that means that's actually a bit of a problem when you forecast currencies as well, just an FYI, because these corporations are very profitable and they repatriate the profits back into Japan. That strengthens the Japanese yen. And so people wonder, why is it such a weak economy, such a strong currency? Well, it's because it's getting all these profit repatriation flows into the country. The question is that a sustainable strategy? And I suspect that ultimately we need to see a turn in demographics, either through immigration or through greater population growth to stabilize things. And Abe, to his credit, is starting to just at the margin trying to get the Japanese accustomed to more immigration. There is now a pilot project whereby 50 Filipino nannies were brought into I think two Japanese cities. But that, you can see that's the glacial pace of liberalization we're talking about. I think the best thing is you'd marry the Philippines and Japan, because you get the best of all worlds. You loosen up the Japanese in the process a little bit, and you maybe discipline the Filipinos a little bit. You get the population growth. That might be something. Although historically, probably not the most sensitive thing to say. So strike
Probably
that from
not.
the record.
Yeah. You didn't really mean that. At any rate, we can continue to talk about a lot of the countries in the region. Let me ask quickly about if you have any remarks on two. And then I have just a couple questions on Pan-Asian issues. India and Korea. India's population is huge. The per capita is still quite low. under $2,000 a year per capita, but growing, the fastest growing economy in Asia. Do you view that as sustainable? What do you think India's role with that huge population is going to be in the kind of time frame you look at?
So the first thing to say is, yes, it is sustainable in some ways because it is not leverage-driven. It's not accompanied with enormous capital outflows. We have environmental issues, we have other issues in India, but it seems in some ways more sustainable than some of the other economies we discussed. India is not going to be the next China in the sense that China's development trajectory over the last 30 years is absolutely unique. I think very few countries in the world could have developed at such a speed, countries of that size, given the project execution, the ability to ramp up infrastructure spending, all of that seems very unlikely in India. But that doesn't mean we should write off India. India could still grow 8-9% per year and would probably be the fastest growing economy at that point, but just not 12, 13, 14% that we saw in China. And, to all the criticisms of the Modi government, he has made quite a few changes that are, in the Indian context, significant. So we have tax reform coming through now. We had a bankruptcy code being enacted last year. The Modi government has piled a lot of resources into infrastructure spending, so that continues to go very well. Right. That can lead to a slight acceleration growth, maybe 7-8%, but it's just not going to be sort of the China of the next China.
And any remarks on Korea? It's in political turmoil, but the economy seems to be moving along. But once again, what is the role of Korea going to be in the Asian economy in the next few years?
Well, one question that investors talk a lot about, and people I converse with, is the worry that Korea could follow Japan in many ways. So it's viewed less as a dynamic economy, despite the fact that it has tremendous companies that are very innovative. If you look at the demographics in Korea, they follow Japan. So there's a sense that, what's the next growth driver in Korea? And this is where this debate about globalization and trade liberalization comes back in, because the Korean economy needs trade.
Yes.
And if we get trade restrictions, if the global trade system gums up, then they cannot generate the growth internally to sustain 3-4% growth. And so that's more of a, in India you could say they have a large enough market where they won't be affected by it.
Yeah. Well, that's great. That leads right into my broader question. We appear, for the moment at least, to be entering a post-TPP world, where there was a possibility. The TPP was an odd duck to begin with, sort of an unusual grouping of countries. It had Japan, but not China, not Korea, not India. This at a time in which, frankly, I think Fred and his colleagues were the first to pick up on the slowing trend of intra-Asian trade. That early on, post the financial crisis, rapid growth in China was doing wonders for the region by sucking in lots of imports of all kinds. But that has, as you pointed out, and in your research has pointed out in detail, has slowed down. So what is the prospect for intra-Asian economic integration, both trade and finance, in this post-TPP world?
So the Chinese, as you know, were pushing the RCEP, the Regional Comprehensive Economic Partnership, which was set up as a rival to the TPP in some sense. And now that the TPP has been taken off the shelf, it's the only game in town. And the negotiations are still moving forward fairly rapidly, so their expectations that by the end of the year, the Chinese will have signed the RCEP, which includes, for those unfamiliar with that, it's essentially all of Asia, excluding Australia and New Zealand. So Japan is into China, India, and Southeast Asia, and Korea. And the idea is to create a big free trade area. The problem is substance. The agreement is nowhere near as substantive as the TPP would have been. And so we shouldn't equate that with a full free trade agreement. Now, my sort of point about this is that for big multilateral trade agreements to work, you need essentially one large economy to take the stab and to press ahead, particularly with concessions to trading partners to get a substantive agreement going. And the way I look at it, perhaps a bit simplistically, is that after the Second World War, the US took that role, consciously reducing its trade barriers, even in asymmetric fashion, just to get other countries to join the liberal free trade agreement, and kind of used the large market as a carrot to get other countries to join in. And ultimately, the view here was that it would be to the benefit of the US economy at the end of the day if you create this liberal trade order, even if in the short run the US would import more than it exports. Now, for that to work in Asia, you essentially need the Chinese to say, you know what, we want a free trade agreement. We understand we need to take the lead. We're going to cut our trade barriers and allow some of the trade partners to maintain some restrictions. The problem is that I'm not sure that kind of leadership role has yet fully emerged with regard to China. And I tell you, that's a real issue, because if you're in Thailand, if you're in India, if you're in Korea, you're extremely scared of reducing trade barriers vis-a-vis China, because the risk is you get swamped with cheap Chinese goods. So the only way to get the Koreans or the Indians to agree to a real regional trade agreement is for the Chinese to essentially make more concessions than the trade partners, ultimately to the benefit.
Right.
But I think that leadership role needs to happen. So I'm a bit skeptical about this Asian free trade region to emerge, because I think the political setup isn't quite as conducive to that.
Exactly. I must say, one of the lessons I learned here in Washington is, so far, if the U.S. isn't engaged, not very much happens. If only the U.S. is engaged, not very much happens. And so what you're saying with TPP, with the U.S. withdrawing from TPP, it's not clear that anything really meaningful, significant can be put in its place.
That's right, yeah.
Very interesting. Well, we could go on, but I'll stop. I won't be selfish, but as you can see, we very much enjoy this conversation with Fred. He's I won't say unique, but very few folks have his perspective on Asia from both the private sector, financial sector, trade, etc. So now let's open the questions to you. And by the way, especially for SAIS students here, Fred has said he would, if you have questions about his career, how he got here, what he did after SAIS, he would be happy to respond to that, as well as to substantive questions about the Asian economy or anything else. We'll start there. Please wait for the microphone. Tell us who your name is and any affiliation, and ask your question.
Ziap Trin, American University. I'd like to ask you, do you think Japan would have a policy that would encourage population growth like France? 3 children per family, and the parents get all the benefits, tax credits, healthcare insurance, education, so on. Are you familiar with the French system?
Yes, yeah. I'm familiar, particularly with the holiday regulations in France. I have a client in Paris who is Greek, and he complains about the number of holidays they get in France. They get 50 days a year, and he said you get nothing done because whenever you want to get something done, your colleagues are on holiday. Anyways, that's a different issue. I think you raise a very important question. Abe has moved in that direction, right? So people criticize the third arrow under Abe, but actually he has done a few things where he's aggressively expanded childcare facilities, which weren't really available sufficiently. He's trying to lean on companies to provide longer maternity leave. He's at the margin, he's trying to rework the tax system because to allow women to work, etc. The big question I have is why hasn't he moved more aggressively in that direction? That's kind of what I wonder. And you almost could make the argument is that the BOJ is pumping so much money into the economy. They have such a vast fiscal stimulus. Why not just use most of that money to fix the population decline? I mean, all what you described, right? Child incentives, I mean, free education, healthcare, so forth, daycare centers, but also even monetary incentives to have children. Why isn't that ramped up to fix a population problem? I'm surprised not more has happened. I suspect it's a little bit to do with the conservative nature of party politics and politics in Japan. But I think that would ultimately be very bullish. And there are, so tongue-in-cheek, there are investors, when I have discussions about this, they're like, why doesn't the BOJ offer for the next 18 months a mother who delivers a newborn $500,000? Because that would very quickly fix the population. Now that is very tongue-in-cheek, but the point being is, there's a lot more you could do to raise the birth rate. And people say, oh, that wouldn't make a big difference. But you know what? Within 20 years, which isn't that long, you would actually then suddenly have a big influx into your labor force. So, and the other thing I would say just on this is that we shouldn't treat demographics as sort of the be-all and end-all. Things can change. So my projection about 2,300, only 13 Japanese or 14 Japanese being left, I wouldn't take that literal because we can't really predict that far out. So in other words, these trends can shift.
Great. Here.
Hi, thanks very much, Dante Mazzari, Georgetown SFS. Just wanted to get back to your slide about infrastructure and kind of growing demand in Asia. I'm wondering first how you assess the ability of the kind of multilateral infrastructure banks, AIIB, but also ADB, in being able to meet that need, and what banks like HSBC are doing in order to calibrate their strategy to meet that need.
So the AIIB and all the other, so the China Development Bank is also engaged. It's not a multilateral bank, but the Chinese Development Bank is also lending overseas. There's a lot of private sector involvement, incidentally, in this, because a lot of these projects are being rolled out. The road and belt projects are often co-financed to a very large degree by private sector bank, private being the large banks in China, which are government-owned but act as private institutions, or foreign banks like ourselves, because these are big infrastructure projects. So the numbers that you read around China's AIIB signed $1.5 billion, that's actually, that's a fairly low amount. There's a lot of private sector co-financing goes in that. So the amount is very significant. I think the numbers are out for the first 9 months of last year. Chinese invested $70 billion in road and belt projects. The year-end figure might be $100 billion. That's some chunky numbers. Now, the issue is twofold. One is that the execution is not quite as simple as the Chinese had imagined. The Chinese are used to building a high-speed rail network within 5 years. It turns out that if you try to do the same in India, you have suddenly land dispute issues, you have contract issues, you have, in Thailand, this famous example is that the Thais insist on Thai labor laying the tracks, whereas the Chinese wanted to bring in Chinese labor to lay the tracks, and then this whole thing just went by the wayside. So very often we get these headline numbers, but the execution problem is falling away. That's a big obstacle. The second issue is, one worry is that as China kind of tries to preserve more foreign exchange reserves, as we have more capital outflows, I think we'll find that the Chinese will become a bit more selective in the types of projects they finance, because they need to harbor their own resources as well. And so it may ultimately be a slower execution than people would like. Lastly, it makes a huge difference in places like Laos, Cambodia, even Bangladesh, Sri Lanka for sure, but it's not large enough to really turn the dial in the bigger places like India, Indonesia, Thailand, so forth. So there are some of the smaller countries, it makes a huge difference, but not in the larger ones.
Mm-hmm. Here.
Hi, thanks. I'm Mark Dallas. I'm at sabbatical in GW Business School right now. One question is, how much weight do you put on sort of these alternative figures that financial institutions come out with regards to Chinese growth? You see it in The Economist all the time that it's actually 4%, and they use the Li Keqiang index of how much electricity is being used as other measures. Do you feel that those are bogus, or do you integrate them, and were your figures sort of based on that at all? And the other thing is, with the RCEP, my understanding was that there isn't in terms of tariffs and whatnot, there isn't a whole lot that China can offer. I mean, tariff rates are already quite low. And so that a lot of these big trade agreements like the TPP were much less about the trade side and much more about, intellectual property and investments and things. So I'm wondering, how much can the RCEP actually do? What can they offer?
So on the first one, the alternative indicators, we don't produce our own. We have sort of stuff we'd like to look at, but we don't find that there's anything very reliable out there. So for example, there's been 3 or 4 years ago, there were a lot of alternative indicators that were published that showed a total collapse in output. And everybody's like, wow, this indicator shows growth is now at 0. It turns out that these indicators weren't as reliable because they relied a lot on electricity consumption, for example. But 40% of electricity consumption in China is in the industrial sector, particularly in steel. And so if steel production goes down, then the electricity numbers completely collapse. But since in the meantime the service sector had expanded, the overall impact on growth wasn't nearly as large. So you have to treat those indicators also with a large pinch of salt. And as far as I know, nobody has found a smoking gun that the indicators are the official data is systematically manipulated. It's more that it is probably not quite as reliable as we would like, but it's not as if they're deliberately kind of tweaked. And so we still use the official data quite a bit. There are private sector indicators which are useful, which we use sort of like the PMIs, for example, surveys. That's very helpful. We look at container traffic and ports. So there's stuff you use, which you use in any economy. But I'm a bit skeptical about these Li Keqiang indices that people would try to come up with. I'm not sure anybody has found sort of the golden rule. That's for that. Sorry, the second question was, RCEP. Yeah, RCEP. On RCEP, you're right. So tariffs don't matter as much anymore. There is, I think, 1 or 2 chapters in RCEP that are supposed to address broader issues as well. So they have the ambition to make it look like a TPP. But I think those are even less rigorous than even the trade, the tariff one. So again, RCEP is probably not, we shouldn't think of this as being substantively anywhere near the TPP. Having said that, though, just getting the thing started, you could argue that this is maybe a basis for future negotiations. So it's still good to have a framework in place, but as it stands now, I'm not sure it's going to be like a game changer for Asian trade.
There in the back.
Thank you. My name is Zheng Song. I'm an independent researcher. My question is, how do you foresee trade policies of Trump administration and its impact to Asia? For example, will a trade barrier targeting China have a disruptive effect to supply chain in the region? Thank you.
Asked me to predict the Trump administration. I would say this: if you take him literally, and there's going to be a 45% tariff on Chinese imports, that's certainly going to be very disruptive, not just for China, but for the rest of the region as well. But
yeah, I don't think he actually said that he was going to do that.
But he might do that.
It was it was kind of a threat if they couldn't come.
If they couldn't, yeah.
I think a lot of people took that as a promise, but it wasn't.
Yeah, so that's a good point. So our view is that pragmatism will prevail here, right? So that because the economic relationship between China and the U.S. is so large that it's nobody's interest to let it sort of escalate the tensions. That perhaps there might be something good at the end of the day that comes out of this, and that is that if Donald Trump kind of brings China to the negotiating table, and you get some sort of a bilateral agreement that addresses some of the concerns, particularly of U.S. exporters to China, you could get an expansion of trade rather than a contraction, and ultimately it's good. And I would actually go as far as saying that sometimes these external negotiations can be a catalyst for reforms within the country. And we discussed a little bit the lack of reform momentum domestically. And I'm a little bit reminded of the WTO accession in 2001, where they essentially, the WTO access negotiations in the late 1990s and early 2000s were a big catalyst for domestic reforms in China. Strengthening the hand of reformers, of technocrats who wanted to push through certain market openings, etc. And so this time around, we may actually find that if it comes to sort of a strong bilateral negotiations, that China surprisingly puts a lot on the table, because that's what many factions within China want to do anyways. And that's often. There was a book recently by a DC insider who talked about this. Sorry, you're a DC insider, so I'm asking you. That book, sorry, I forgot the name, but it traces through the history of the collaboration between foreign technocrats and Chinese technocrats, and how they used that relationship to drive through reforms. The World Bank also has been very instrumental over the years in trying to encourage reforms.
Yeah, that was very clear at the time of the WTO ascension. Zhu Rongji and his government were anxious to use that as a lever for domestic opening that I think has been mutually beneficial. So I wouldn't rule it out.
Yeah.
Over here.
Hi, my name is Yoni Katz, and I'm a China Studies concentrator at SAIS. I'm wondering your thoughts on Hong Kong's financial hub status, given the recent political developments there, its autonomy, and I'm imagining kind of a replacement from Shanghai and Singapore as well in terms of being that hub.
I don't think the recent political incidences have a big bearing at the moment on Hong Kong as a financial center. You could argue that some of the capital control issues or tightening of regulations in the mainland actually strengthens Hong Kong vis-a-vis Shanghai, at least in the near term. So that's certainly there. With regard to Singapore, really Hong Kong and Singapore have now kind of divided up a little bit their specialization. So Hong Kong has much more of an equity market, much more private equity access to China, whereas in Singapore we have more FX trading, we have private banking, we have commodities trading. So that's a bit of a split in terms of the specialization. So I don't really see that disappearing anytime soon. And there's a lot of things, so despite some of the political issues, where Hong Kong still has a very deep bench in terms of the rule of law, a strong legal system, and just legal professionals, the whole infrastructure that's still there. So I'm not terribly concerned about any big disruptions in the near term. Yeah.
Interesting. Out back.
Stanley Kober. I have a question about trade. Recently, South Korea announced that its exports had declined for 2 years running. This is the first time that's happened in almost 60 years. And I was struck by an article, I'm looking at it now, a 3,200-ton Goliath crane in the shipyard in Changwon had been valued at $22 million. It was sold off to Romania. They said the price had plunged to $2 million. That suggests they don't see the trade coming back. And that's what concerns me here. The article goes on to say, the volume of orders for new ships is expected to remain at a third of normal levels in the coming year. This is very prolonged, that's very sharp, and it's not coming back. What is going on with trade?
Yeah, we share some of the concerns, and that's why sort of my remarks talked a little bit about the structural trade slowdown. It's not just a short-term cyclical issue. We have long-term issues. Now, with Korea in particular, about 15 to 20% of their exports are either vessels or any type of equipment that feeds into the global mining sector. So during the period when you had a global mining investment boom between 2005 and 2012-13, Korea was doing extraordinarily well, right? They built LNG tankers, exploration platforms, very high value added stuff. They built entire mines. I remember in Western Australia, I visited a mine around Perth. There was a $15 billion mine built from scratch, which was done entirely by a turnkey by a Korean company. That's what Korea is known for. Now, the downturn in global mining capex and the mining sector, that has hurt Korea particularly hard. Plus, the glut in global shipping is, and that both of them together could wipe out 10-15% of Korea's exports. That is massive. And the Korean government has acknowledged that, saying there could be, in shipbuilding directly, 70,000 job losses over the next 12 months, and there could be another 200,000 job losses in industries that sort of feed into shipbuilding. So that's something the Korean government is certainly quite exposed to. And that affects these trade numbers quite a bit. If you look at other sectors, semiconductors, Samsung, telephones, they're still doing rather well. But here, what we find is increasingly that a lot of this stuff is actually produced in Vietnam or in China, is no longer produced in Korea. So there's also a bit of hollowing out, if you will, with some of the production moving offshore. And that, too, is then harming Korea's exports. The bottom line is Korea is a good example of the structural trade deterioration that Asia faces. And going back to my presentation, my point was that it's understandable that Asia over the last 6-7 years would have leveraged up its balance sheet to kind of cushion the impact from weak Western demand. The problem is now we've kind of stretched that growth model to the limit, and ideally we would want the Western world to come back and start to buy our products again so we can get away a little bit from this debt-fueled growth. The problem is that shift isn't happening. And it's not happening for structural reasons. And on top of that now, if we add protectionism, that means that we really have a growth problem across Asia.
Very interesting. Yes. Yeah. We'll get you two, and then that will be it.
Thank you. Hi, I'm Courtney Rickert McCaffrey. I'm with A.T. Kearney's Global Business Policy Council. And you talked a lot about the debt levels and leverage ratios in different economies in Asia. But I was wondering, if one kind of goes over the cliff, what's the risk of contagion?
Yeah, so that's a good question, because we often get, so there's an analogy being drawn between now and 1997, and if you remember my second chart, we went up to the peak, went down, and then we're now above the previous peak. So people look at this chart and say, "Oh my God, this is just another Asian crisis waiting to happen." I don't think we're quite in that running that risk, because there are a lot of differences also with 1997. One is that we have current account surpluses, we have high FX reserves. A lot of the debt is local currency denominated, no longer US dollar denominated. So there are a lot of buffers there. Asia has a growth problem, but it doesn't have a problem of imminent financial stress. So unless you think US interest rates go up very sharply in the next 12 months or 18 months, which is a possibility, up 200, 250 basis points, this is more of a growth problem than one that causes imminent financial stress. So the risks of contagion are fairly minimal. There are a few countries that are more vulnerable in Asia than others. So Malaysia stands out, for example, as being among the more vulnerable. And so the question is, if there was something that happened in that country, how would it spread? Indonesia and Singapore might be vulnerable on that front. But generally speaking, because the macroeconomic balance sheets are stronger, the degree of contagion should be much lower than what we're used to in sort of the classic emerging market crises, whether it's 1997 Asia or Latin America, I guess in the early 2000s, for example. So I think that still remains the basic view here.
Okay.
Two there.
Yeah, these last two questions. Let's start there.
Hi, my name is Aarti. I'm a second-year SAIS student here. Thank you for the talk. I think that was really useful. I have a question about the demonetization in India, and what are your thoughts on it? So there's this theory that, of course, GDP went down immediately, and it's contracted. It's not so recent anymore. There's been about 3 months. However, there's this alternate theory that the informal sector has sort of incorporated into the formal sector. So the cash-based economy has now come into this formal sector. So it might be a bit early at this point, but I'd like to get your thoughts on that as well. Thank you.
Good question.
Yeah, the demonetization was clearly a jarring event for a lot of people, especially because it line up at banks for many hours to exchange your cash. But it seems as if the impact on economic growth wasn't quite as severe as people had feared. And in part, in the goods-producing sector, what happened is a lot of people bought more goods as a store of wealth. And so it actually, in some measures, good producing did actually better than expected. We still have to see how the impact on services was, because you can't store services, so that's a bit of an issue. But generally speaking, the view is that the impact's been less. And so now we're looking at essentially a V-shaped recovery, because the process has been concluded. By March, all banknotes will be exchanged. And people are already talking now about potential disruption from the GST rather than demonetization. There are some benefits, and I think the benefits over time will outweigh. One is that tax revenue, I think, will go up, and it's already surprised on the upside, at least in the recent months. And that is good for India, because it gives more fiscal leeway. And the other one is the bringing much more cash into the banking system has actually made the banks more flush with money. It has brought, advances to digitization of payment transactions. So I think these benefits are actually going to be quite substantial. So bottom line to me, it was there could have been probably some ways to better execute it, but I think in the medium term, the benefits will slightly outweigh the negatives here.
Thanks. And now our last question.
Yeah. My name is Longhan Wawang, first year International Political Economy concentrators at SAIS. So I have two questions, one about China and the other is about Japan. And as for China, what is your estimate of the level or range about the potential Chinese growth? And how long does it take for the recent measures such as second child policy or emphasis on innovation will take into effect in order to lift the potential growth? And the other one is about the Japanese inflation. So Bank of Japan has introduced the inflation target of 2%, I think a couple of years ago. But so far, it seems that those measures are not really successful. So in your opinion, what do you think is the fundamental problem with the Japanese deflation, and how Japan should overcome that in order to escape the spiral of deflation? Thanks.
So on China, the potential growth rate is a moving target because of demographics that are adverse, and secondly, because as per capita income increases, naturally you would expect the growth rate to slow down. And so when we do our medium-term forecast, it's a stepwise change where you go from sort of 6.5 to 6 to 5.5. I would say that maybe by the early 2020s we stabilize somewhere between 4% and 5%. This is the potential growth rate. This is not the realized growth rate. We should stress that. And that's the two-child policy, I think, will not make a big difference, at least for the foreseeable future, just because the Chinese themselves are not responding to it for social reasons. So we're not seeing suddenly a baby boom, and I think that's going to be a restraining factor. But I think the innovation and the improvement in human capital is very substantial. In fact, I think that's one of the misinterpretations about China, is that China is not innovating enough. I think China is innovating increasingly. I've lots of conversations, as you can imagine, with company CEOs, and time and time again, what they tell me about innovation in China just blows me away. Shenzhen has become like a Silicon Valley across the border from Hong Kong. I had a conversation with a Silicon Valley CEO who told me that in the internet space, idea generation in China is the same, is on par with idea generation in Silicon Valley, but idea implementation is twice as fast as in Silicon Valley. If you go to pharmaceuticals, for example, a lot of global pharmaceutical companies are moving now their R&D into China. In the automotive sector, there's a lot of R&D going on. So I think actually innovation is something that will boost the growth potential. But I would say 4 or 5% sort of in the 2020s is roughly where we're at with China. With Japan and inflation, the number one thing is demographics. If your population shrinks, your market shrinks, and that just means persistent deflationary pressures. And so we need to fix the demographics. The second thing that plagues Japan in particular is inflation expectations. After 20 years of consistent deflation, you really need to have a jarring event that gets people to think about inflation rather than deflation. And it's only when inflation expectations from deflationary mindset to an inflationary one that you really get inflation pick up. And that's a good example is the so-called Shunto negotiations for wage increases, which are coming up. So every year the Chinese labor unions sit down with employers and they discuss wage increases. Now, for this year, the expectations are, because the labor unions already said, that they only look for sort of 0.5% or 1% increase in wages, which is nothing. But yet the labor market is at the tightest since the early 1990s. The unemployment rate is as low as, I think, 93 or 94. Companies can't get employees. And yet the labor unions are very conservative in their demands because they kind of think, well, you know, realized inflation is going to be very low. You know, we don't want to put too much pressure on our employers. And so, you know, nobody believes really that inflation could be 2 or 3%. And that you need to overcompensate for that with higher wages. And so this expectation component, I think, is very important.
Yeah. And after all, per capita real income is growing.
Yeah.
Which, despite the shrinkage of the numbers. At any rate, well, Fred, thank you very much. I suspect everyone has been impressed by the depth and breadth of your knowledge, the clarity of your views, and the clarity of the reasoning underpinning those clear views. So I think you're a great...
SAIS education, what can
I was going to say, you beat me to it. At any rate, please join me in thanking Fred for his... We are adjourned. Thank you.